European debt. The European sovereign debt crisis, unfolding from late 2009 to around 2015, was one of the most severe financial events in the history of the euro. It shook the economies of multiple member states and raised doubts about the survival of the monetary union. The crisis began in Greece, when the newly elected government revealed that the 2009 budget deficit had actually reached 12.7% of GDP, double the previously reported figure. Public debt stood at 113% of GDP, far above the 60% ceiling set by the Maastricht Treaty. Market confidence collapsed, bond yields soared, and the turmoil quickly spread to Ireland, Portugal, Spain, and Italy. By 2010, several countries lost access to capital markets and were forced to seek financial support from the EU, the ECB, and the IMF. This was both a financial crisis and a major test of Europe's political cohesion. The roots of the crisis lay in structural weaknesses of the Eurozone. The bloc had a common monetary policy under the ECB, but lacked a strong federal budget and a reliable backstop for governments facing liquidity shortages. The Maastricht fiscal rules were frequently violated without enforcement. Adopting the euro allowed peripheral economies to borrow cheaply, but much of the money flowed into consumption, public spending, and real estate, fueling property bubbles in Spain and Ireland and current account deficits in Greece and Portugal. Many governments failed to consolidate their budgets during growth years, with Greece as the most notable case of persistent high deficits. The global financial shock of 2007-2008 caused Eurozone GDP to contract sharply. Governments launched stimulus measures and bank rescues, worsening deficits. Ireland was hit especially hard as its government absorbed massive private banking debt after the collapse of its real estate bubble, converting private liabilities into public debt. In October 2009, Greece disclosed the true deficit figures. Its bonds were downgraded to junk status, and borrowing costs surged. In 2010, Greece accepted a €110 billion bailout from the EU and IMF. Tied to strict austerity measures, the EU created the European Financial Stability Facility. And by the end of the year, Ireland requested an €85 billion package to rescue its banking sector. In 2011, Portugal secured a €78 billion bailout, while Spain and Italy faced rising borrowing costs. Political instability grew, and several leaders, including Italy's Silvio Berlusconi and Greece's George Papandreou, resigned. The crisis peaked in 2012. Greece carried out the largest debt restructuring in history, wiping out about €100 billion of private debt. Spain requested €100 billion to recapitalize its banks. In July 2012, ECB President Mario Draghi pledged to do whatever it takes to preserve the euro, followed by the launch of the Outright Monetary Transactions program, which calmed markets. In October, the Permanent European Stability Mechanism replaced the temporary EFSF with a €500 billion fund. From 2013 to 2014, the situation stabilized. Ireland and Portugal exited bailout programs, Spain returned to growth, and Greece regained partial market access. In 2015, however, Greece entered another crisis after the anti-austerity Syriza party won elections. The country fell into technical default with the IMF, but ultimately accepted a third bailout, worth €86 billion, narrowly avoiding a euro exit. Public debt levels surged. Greece's debt reached nearly 180% of GDP, Italy's about 130%, Portugal's above 130%, and Spain's over 100%. Borrowing costs soared, with Greek yields at times exceeding 30%. Greece's GDP contracted by 25% between 2008 and 2015, Spain's by more than 9%, and Portugal's by 6%. Unemployment surpassed 27% in Greece and Spain, with youth unemployment exceeding 50%. Austerity measures cut welfare and living standards, fueling waves of protests across Europe. Trust in both the EU and national governments fell sharply, destabilizing the political landscape. The crisis spurred wide-ranging reforms, The banking union was established, introducing stronger supervision and resolution mechanisms for banks. New fiscal frameworks, such as the Six-Pack, Two-Pack, and the Fiscal Compact, strengthened budget discipline, while the European semester allowed the European Commission to review national budgets in advance. The ECB confirmed its role as a lender of last resort through asset purchase programs and other extraordinary measures. Key lessons included the need for risk-sharing mechanisms, fiscal discipline during growth years, avoiding excessive tightening during recessions, and financial transparency to maintain market trust. Clear policy communication, such as Draghi's 2012 pledge, proved capable of stabilizing markets without immediate action. The crisis fueled the rise of populist and Eurosceptic movements, most notably Syriza in Greece, Podemos in Spain, and the Five Star Movement in Italy, and contributed to the political environment that later led to Brexit. In popular culture, the events were documented and analyzed in works such as the film Debtocracy, the BBC's The Great Euro Crash, and Yanis Varoufakis's memoir Adults in the Room. In academic research, the crisis became a defining case in monetary economics, public finance, and sovereign debt management. Its lessons shaped the EU's later responses to shocks, particularly the COVID-19 pandemic, when the bloc for the first time issued joint debt to fund a recovery package. Great Recession. The global financial crisis of 2007-2008, often referred to as the Great Recession, was the most severe economic shock since the Great Depression of 1929. Originating in the United States, the crisis began with the collapse of the housing bubble and the subprime mortgage market, a high-risk lending model fueled by the expectation of ever-rising home prices. When housing prices started to decline in 2006, millions of loans became unpayable, triggering the downfall of a wide range of financial products tied to these mortgages. The turmoil quickly spread worldwide through the interconnected banking system and capital markets, causing millions of people to lose jobs and homes and shaking public trust in the financial system as a whole. After the dot-com crash of the early 2000s and the September 11 attacks, the Federal Reserve cut interest rates to historically low levels to stimulate the economy. Cheap credit fueled a housing boom. U.S. homeownership rates peaked near 70%, while home prices doubled compared with the late 1990s. At the same time, the subprime mortgage market exploded, as banks extended credit to borrowers with low incomes, poor credit histories, and little capacity to repay if rates rose. These risky loans were bundled into mortgage-backed securities, MBS, and collateralized debt obligations sold globally to investment funds and financial institutions. Rating agencies severely underestimated the risks, granting many of these securities AAA ratings. Meanwhile, deregulation, such as the repeal of the Glass-Steagall Act, relaxed oversight of derivatives, and higher leverage allowances for banks left the system more fragile. Surplus capital from Asia and the Middle East flowed into U.S. housing securities, further inflating the property bubble. From 2003 to 2006, U.S. home prices rose about 10% annually, fueling construction and speculation. But when the Fed began raising rates in 2004, debt burdens mounted, housing demand cooled, and by 2006, prices peaked and started to fall. In 2007, defaults surged. Numerous smaller financial firms collapsed, mortgage-related investment funds froze, and a bank run erupted in the UK. With the failure of Northern Rock, the crisis peaked in 2008. Bear Stearns was forced into a fire sale to J.P. Morgan. Lehman Brothers filed for bankruptcy, the largest in U.S. history, and AIG required a government bailout. The entire financial system teetered on the brink. Stock markets crashed, credit markets froze, European banks were nationalized, and all three of Iceland's major banks collapsed. Although governments deployed massive rescue packages, the global economy slid into deep recession by 2009. The immediate impact was severe. In the U.S., more than 9 million jobs were lost, and unemployment doubled. Housing prices fell about 30%. More than 8 million homes went into foreclosure, and millions of households were left with negative equity. Household wealth dropped by more than $14 trillion. The S&P 500 fell 57% from its 2007 peak to its 2009 trough. Europe also suffered, with average unemployment surpassing 10%, especially in southern Europe. Global trade contracted by nearly 10%, investment collapsed, and countless businesses failed due to lack of liquidity. Banking, insurance, real estate, industry, and retail were all hit hard. Hundreds of banks were forced to shut down or merge to prevent systemic collapse. In response, sweeping reforms were introduced to restore confidence and restructure the financial system. In the U.S., Congress passed the Dodd-Frank Act in 2010, which included the Volcker Rule restricting speculative activities by banks. Large banks were required to prepare living wills to outline how they could be dismantled in case of insolvency. The Consumer Financial Protection Bureau was created to strengthen oversight. Internationally, the Basel III framework tightened capital, liquidity, and risk management requirements. Central banks worldwide adopted ultra-loose monetary policies, keeping rates near zero, launching massive asset purchase programs, and using forward guidance to stabilize markets. The crisis also fueled social movements like Occupy Wall Street, highlighting inequality and accelerated stricter ethical standards in finance. Culturally, the crisis inspired widely acclaimed works such as The Big Short, Inside Job, and Margin Call, which helped the public grasp the complexity, greed, and risks embedded in the financial system. Personal financial awareness grew, with more people prioritizing saving, reducing debt, and building household emergency funds. In economic research, behavioral finance theories and Minsky's instability hypothesis gained traction, emphasizing market psychology and the cyclical nature of confidence. The idea of financial stability as a standalone policy goal, on par with inflation control and growth, became more widely accepted. The 2007-2008 global financial crisis served as a stark reminder of the deep interconnections of modern economies and how systemic risks can spread rapidly without proper oversight. It not only reshaped how banks and investors operate, but also laid the groundwork for a new era of global economic policy. One where stability, transparency, and risk control are prioritized above short-term gains. Corona crisis. The global financial crisis triggered by the COVID-19 pandemic, also known as the Great Lockdown, began in early 2020 when the SARS-CoV-2 virus spread worldwide, causing the first synchronized global recession since the Great Depression of the 1930s. The outbreak started in Wuhan, China, in late 2019 and was declared a global pandemic by the WHO in March 2020. Measures such as lockdowns, social distancing, and border closures to contain the virus almost froze entire sectors of economic and social life, from manufacturing and trade to tourism and services. As a result, global GDP fell by about 3.1% in 2020, the steepest contraction in decades. International trade, investment, and consumption collapsed. The crisis not only shook financial markets with the sharpest volatility since 1987, but also created a massive employment shock, pushing tens of millions into poverty and reversing development gains built over decades. Even before the pandemic, the global economy was slowing due to U.S.-China trade tensions, political instability in various regions, and high debt burdens. Global supply chains, designed under a just-in-time model to minimize costs, lacked resilience. A single disruption in a key link could trigger widespread breakdowns. When China, the world's factory, went into lockdown, supplies of raw materials and components were cut off, immediately hitting industries worldwide. Labor markets were vulnerable because of the high share of short-term, informal, and service sector jobs. After the 2008 financial crisis, global interest rates had remained at historic lows, while public and corporate debt had risen, limiting policy space. Economies dependent on tourism, remittances, and global consumption were hit especially hard when borders closed and travel halted. By late 2019, the virus spread rapidly, and in March 2020, the WHO declared it a pandemic. Widespread lockdowns followed. Financial markets plunged, with major U.S., European, and Asian indices falling 20 to 30% within weeks. Record amounts of capital fled emerging markets. At the same time, an oil price war between Russia and Saudi Arabia coincided with collapsing energy demand, pushing U.S. WTI crude futures into negative territory for the first time in April 2020. In the second quarter, more than half the world's population was under lockdown. Industrial production and services saw record declines, and sectors such as airlines, tourism, hospitality, and retail nearly shut down. U.S. unemployment spiked from 3.5% to 14.8% in just 2 months, while the world lost the equivalent of 195 million full-time jobs. Governments responded with unprecedented stimulus. The U.S. passed the $2.2 trillion CARES Act. Japan committed support worth more than 40% of its GDP, and the EU suspended fiscal limits to allow extraordinary spending. Emerging economies also launched large relief programs. Central banks slashed interest rates, injected liquidity, and expanded asset purchase programs. The Federal Reserve cut rates to 0.25% and opened swap lines with other central banks. The ECB launched its €750 billion Pandemic Emergency Purchase Program, and the Bank of Japan, along with Asian central banks, adopted aggressive easing. These measures stabilized markets by mid-2020. Economies rebounded in the second half of the year, but renewed outbreaks forced renewed restrictions. In 2021, vaccines were rolled out widely in advanced economies, lifting global growth to about 5.8%. Recovery, however, was uneven. Rich countries rebounded quickly, while many low-income nations lagged due to vaccine shortages and limited fiscal capacity. By late 2021 to 2022, inflationary pressures emerged from supply chain disruptions, rising commodity prices, and surging demand, forcing many central banks to reverse course. The pandemic caused severe short-term damage. Global GDP fell 3.1% in 2020, the sharpest decline since World War II, and most economies contracted. Budget deficits soared, and global public debt reached around 100% of GDP, a record high. Corporate debt also spiked as companies borrowed to survive. Labor markets collapsed. Hundreds of millions lost jobs or faced reduced hours, with women, youth, and informal workers hit hardest. Extreme poverty rose for the first time in over 20 years, with an estimated 115 million people falling below the $1.90 day poverty line. Supply chains broke down, causing shortages of masks and medical equipment early on, followed by chip and electronics shortages throughout 2020 2021, while shipping costs multiplied. The airline, tourism, and hospitality industries were devastated, with international arrivals falling by more than 70%. Many airlines required bailouts or went bankrupt, and millions of small businesses shut permanently. Developing economies dependent on exports and tourism recovered more slowly, while carrying heavier debt burdens. Inequality widened, both within and between countries. Long-term changes also took shape. Digital transformation accelerated. E-commerce, remote work, online meetings, and distance learning became widespread, reshaping consumption and business models. Supply chains began to shift toward diversification to reduce reliance on single sources, especially in strategic sectors like healthcare and semiconductors. Public health systems were reassessed, with renewed focus on rapid response capacity, medical stockpiles, and vaccine research. Policy lessons included the effectiveness of large-scale, coordinated fiscal and monetary responses, as well as warnings about the risks of high debt, asset bubbles, and inflation afterward. The crisis underscored the importance of maintaining fiscal buffers in normal times, directing crisis spending into infrastructure, technology, and green transition to support both short-term recovery and long-term resilience. It also reinforced ideas of economic security and selective globalization, with countries seeking more reliable trade and investment partners. International cooperation was recognized as essential for addressing global shocks. The pandemic reshaped work culture and daily life. Hybrid work became common, with many moving to less crowded areas thanks to remote jobs. Online communication, entertainment, and shopping became ingrained habits. The cultural sector suffered from closures, but adapted with virtual concerts, exhibitions, and online events. Scientifically, the crisis marked a milestone. Vaccines were developed in under a year, with mRNA technology deployed at scale for the first time, saving millions of lives. Artificial intelligence and data science were widely used for outbreak prediction, health analytics, and accelerating drug and vaccine development. Public awareness of systemic risks and the state's role in safeguarding welfare grew, with higher expectations for preparedness against future shocks. The pandemic also left its mark on popular culture, inspiring music, films, and literature that captured the collective experiences of this unprecedented period.